morning. You're watching Businessworld Live. I'm Danny Laurel.
And I'm Jesse De Los Santos. Here are the biggest stories to kickstart this trading day, Thursday. Analysts forecast the Philippine economy to remain a laggard in Southeast Asia this year.
Researchers at Octa observe a downward trend in new infections in Metro Manila, but they say the region is still at critical risk for COVID-19.
The PSE approves the 10 billion peso IPO of Citicorp Energy REIT Corp. The company is set to debut as the country's first energy REIT next month.
And the no vaccine, no ride policy in Metro Manila continues to sow confusion among the riding public. We begin our broadcast with, unfortunately, another bleak forecast of the domestic economy.
Analysts said the Philippines is likely to remain among the laggards in Southeast Asia this year as policy direction in managing the COVID-19 pandemic remains unclear. Now, Yuben Paracuelas, chief economist for ASEAN at Nomura Holdings, said the Philippines and Indonesia would be the laggards in the region as they continue to struggle to contain the health crisis and face the threat of emerging variants. Meanwhile, DBS Bank's chief economist Taimura Baig said the Philippines, together with Indonesia and Thailand, have been deeply hurt by the pandemic, and these countries still do not see any clear light as to how they will approach 2022 in opening up their economy and drawing foreign tourists to come back. Baig said tourism is a critical component of these countries' economies. He then said that the Philippines, Indonesia, Thailand, as well as Malaysia are poised to face substantial scarring in their economic output due to uncertainties in the tourism sector.
Now, the Octa Research Group reports that new cases of COVID-19 in Metro Manila are now on a downward trajectory. Professor Guido David says reproduction number in NCR has decreased to 1.79, while the weekly growth rate dipped further to negative 10%. David says this pattern is very similar to that seen in South Africa, where a dramatic decrease in infections was observed following the Omicron-driven surge. Still, David clarifies that Metro Manila is still at a critical level. The health department has meanwhile confirmed 2 deaths among the country's Omicron cases. The agency says both individuals were more than 60 years old, unvaccinated, and had pre-existing medical conditions.
Things are likely to be improving already in the NCR, but outside the NCR, it's going to be an increase like we haven't seen before. Kumbaga, kung anong na-experience natin sa NCR, it will likely be experienced in many other provinces and LGUs. The surge of the Omicron just ends in about 1 month.
That rebound was short-lived and more profit-taking yesterday on the reopening stocks. How are malls doing today?
All right, well, let's take a look first on that profit taking you're talking about. It seems to be continuing until this open. We are still down. We're down by 0.2%. So we had broken above 7,300 already. Now back to those 7,200 levels. Let's take a look at those movers here. As you mentioned, it was really the mall and retail stocks which dropped yesterday. Those, of course, amid curbs and foot traffic. Phil Stocks had said less foot traffic would negatively affect the earnings of the malls and retailers. And they also mentioned that perhaps the impact would not be as significant as before. We've seen those lockdowns before, but still it affects the sentiments and the pace of recovery. And one of the worst performers, Ayala Land, that was down by 3.6%. Robinson's Land as well, and SM Prime. Whether there is a reversal is not very clear. You do see Robinson's Retail gaining a touch. It's up by 0.4%, but yesterday it was down by as much as 2.5%. But you do see Pure Gold reversing fortunes here. It was one of the biggest losers as well yesterday. But the best performing is JG Summit together with a couple of other players like energy players, bank players. So not necessarily a reversal when it comes to the malls. And you can see that on my terminal here. SM Prime still down by 0.6%. Ali is still down by 0.6%. So unfortunately, the malls aren't doing that great. And this as foreign investors had sold Philippine stocks for the fourth straight day yesterday. We lost around 144 million pesos to our foreign investors. Let's take a look at one specific stock here, Mega World, which is down by 0.3%. This despite them having announced yesterday that they will be buying a Santa Cruz property that's in Manila. That's 2.2 hectares, and that is from Manila Jockey Club, which will be part of their township portfolio expansion, according to them. And that consideration is around 1.9 billion pesos. This comes, of course, after the board had approved in December the sale of four prime buildings in eco zones to MREIT for 9.11 or 12 billion pesos. And still on REITs, we had mentioned that earlier on. Just a quick check on those REITs. We've already got this as, of course, Citicorp Energy REIT will be hopefully the Philippines' first energy REIT. That they have received the approval from the PSE for the IPO. That's worth about 10.1 billion pesos, pricing at 3.15 pesos a piece. The listing will be around February 17. They have, recall, solar plant capacity of around 1,500 megawatts with 120.5 megawatts underway. Now back to the index, Jess. One house is calling a double-digit surge by the year end. And here with us to explain this is Jackie De Jesus. She is the head of research at Maybank. Hi, Jackie, and welcome.
Hi, good morning, guys.
Hi, Jackie. Let's talk about your optimistic view on the markets here for 2022, 8,200, and we're now at 7,200. It's quite a
Mhm.
feat. That's 13% gain from yesterday close. What are your assumptions here? And, to what extent is there a best case and worst case scenario?
Okay, so our 8,200 is basically based on a bottoms up approach of a 90% year-on-year growth for this year. So we are looking at a sustained growth momentum. We're still in a recovery cycle, and we think that will continue for 2022. Um, Majority of the growth will really be coming from the cyclicals. We think it's the year of the cyclicals this year. We're talking about property, banks, also the property and banking led conglomerates. And bulk of that growth, about 70% of the 19% earnings growth we're looking at for this year will really be coming from those key sectors. On a downside, the downside scenario that we're looking at is really more external. A somewhat downside risk would be specifically on the interest rates, potential interest rate hikes or peso weakness arising from credit downgrades for the country and also U.S. Fed tapering. However, I'd like to maybe stress that from a fundamental standpoint, we expect these two to have minimal impacts to corporates, given that your balance sheets are basically cashed up. A lot of the debt is really fixed already and peso denominated, and also majority of their operations um, are domestic. So a worst case scenario, we're looking at about 7.4. That's midway between standard deviation and our PE target of about 19 times PE for the market. And then best case, assuming we open up much earlier, we de-escalate the lockdown restrictions much earlier than our July forecast. And we could be looking at a PSE of 8,400 by year end.
Okay, you did mention that most of these earnings, 70% will come from two key sectors, properties
Mm-hmm.
and banks. Give us a rationale for this because the loan growth has been pretty slow when it comes to banking sector, and then when it comes to the property space, there's some new trends here where people might never go back to the office or work from home is here to stay. What is making you so optimistic that these will see rebounds?
Yeah, so for the property sector, we're really more positive on the developers more than the mall operators. Yes, the reopening story will definitely bode well for the entire sector, and the mall business and as well as the office business will definitely be still sort of like gravy to the whole story. But the positivity is really on the property development side. Demand continues to be strong, and when you reopen up the economy, we do expect construction activity to also improve, which will translate to earnings bookings for a lot of these property developers. On the bank side, they are also an indirect beneficiary of the reopening. For this year, we're actually looking at a 9 to 12% rebound in loan growth. That's coming from almost flat to a contraction in 2021. So base effects should come into play here, and we're also expecting credit costs to be lower. So provisions expense will also we're also expecting to normalize this year.
Okay,
Okay,
sorry, one last follow. Sorry,
go
Jessa.
ahead.
One
Go
last
ahead. Go
follow up
ahead.
on
Sure.
the banks. Do you feel that the provisioning is already done for all the non-performing loans that we might be seeing if we have more lockdowns this year?
What we noticed from last year is that number one, a lot of the provisionings were really front loaded. So it was more of the banks also behaving conservatively. Majority of the provisioning is already at 90 to 100%, which we feel is basically enough for the exposures that we have. Second, we also saw a lot of credit policy tightening among the banks. It was much hard, like they were more, I guess, selective in the loan exposures that they have, which is why we saw consumer loans basically contract last year as well. So moving into 2021, we think provisioning will be normalized. It's not going to be zero, but we're definitely past the sort of like peak provisions that we saw in 2020 and 2021.
All right, Jackie. Well, you remain, of course, bullish for the banking, the property sector. Can't say the same, at least based on your report for the telco sector. Why is the
Mhm.
space an outlier? And do you think it's already overvalued as a lockdown stock? And should we be rotating as well into cyclicals at this stage?
Okay, for the telco sector, earnings wise, we expect it to be flat to maybe contracting by about 3%. The main reason for that is we're expecting increased competition in the wireless segment. Plus the fact that the past few years increased capex will likely translate to increased depreciation expenses for this year as well. Having said that, some of the telcos have been I won't necessarily say it's overvalued on a 1 year view. There's definitely lots of legs in the telco sector, particularly as they move towards more tech on the e-payment platforms and as they develop that space. However, we do think that a rotation could be good on a 1 year horizon, mainly because the property sector has been lagging and the bank sector has been lagging as well, and we expect from a base from an entry level, from an entry point, we do think that those are the sectors to play for this year.
Okay, you mentioned in your report downside risks here. You've got
Mm-hmm.
specifically the Fed tapering, not just the Fed, but other central
Yeah.
banks. Inflation in the U.S. Decades high, and even us here, looming threat of inflation might be behind the rate hikes of the Fed, and we might have to follow suit. What's going to happen, to the property space if we have higher interest rates? What's going to happen to the banks in terms of their margins, and especially consumption if interest rates are high and inflation is still high?
So yes, so those are definitely downside risks. But what I think I did not highlight as well is also the potential upside risk should we reopen up much faster. So I think it's a balancing act. Um, if you when we talk to the banks that we cover, there seems to be much more leeway towards unlike towards consumer lending, for example. So mortgages could still there will be appetite for banks to lend more to hard assets like mortgages, for example, which should help sort of like the property sector as well. And then secondly, I think what we're also seeing is a lot of unspent um, sort of like revenge spending as well. So there's also a shift in the way Filipinos are looking at residential properties, unlike before wherein you would want to be in more um like in places closer to where you work to avoid traffic. Now there's a shift towards more horizontal developments, and that sort of like rotation as well is helping the property sector because land outside of the city will also be more affordable. So the affordability matrix, I think, is also changing as well as sort of like the improvement in the macro economy.
Okay, Jackie, looking at your report as well, you did mention here that Ayala Corporation is still your top pick for the
Yes.
year. What upside potential are you seeing here?
Okay, so for the conglomerate sector, we do think that it's mainly driven by NAV accretion. The stock performance is mainly driven by NAV accretion. And while the reopening theme for this year will definitely bode well for all conglomerates, we do specifically like Ayala Corp for their more deliberate portfolio management for this year. They came out with a 3-point strategy last year wherein they will divest out of their non-core businesses and basically invest more in healthcare and logistics, which are high growth segments for them. So that sort of like combination of an improving macro environment and their deliberate portfolio management, we think will definitely extend their NAV accretion story far beyond 2022, which is why we like them.
Okay, what target price are you seeing here for AC?
So we have 1,070 by year end. So it's a 12-month target
Wow.
price. So yeah, very optimistic. Yeah,
Okay, very optimistic. And thank you so much for
thank
those
you,
insights. Of course, Jackie De Jesus, Head of Research at Maybank.
thank you.
The no vaccine, no ride policy, Dan, continues to show confusion among the riding public here in NCR.
And some workers were still reportedly barred from public transportation despite clarifications from the government that they are exempted from the policy. Mobile journalist Pamela Vasquez gives us the front seat to this story.
After a huge backlash, workers are now exempted from the no vaccine, no ride policy. Authorities scrambled to clarify the rule after many were reportedly barred from taking public transportation.
Simulat sa pool, pag sinasabi kasi namin essential, kabilang dyan yung work. Exempted po yan.
According to DOLE and DOTR, unvaccinated workers in the formal sector may present either government or company-issued ID or employment contract or certificate. For those in the informal sector, unvaccinated workers may show their barangay ID or certificate or a barangay health pass. Complicating things even more is that the exemption only applies to workers in industries that are allowed to operate under Alert Level 3.
Lahat po ng close under alert level 3 as identified by the BTI. Kasi paano naman po papasok yung mga manggagawa doon kung hindi naman po pinapayagan na mag-operate.
Dolly admitted that the policy has been a challenge to implement.
We have 18 major sectors. Siyempre, ang ordinaryo po na driver halimbawa, hindi naman niya alam kung ano-anong mga sektor yung pinag-uusapan sa ating ekonomiya na pinapayagan.
Meanwhile, other individuals also exempt from no vax no ride are those who have a medical or job appointment and those applying for passports or licenses. Also exempted are people buying essential goods, those who cannot get jabbed due to medical reasons, and those heading to COVID vaccination sites. Individuals must present their medical or application appointment or schedule, but those who cannot get jabbed must present their medical certificate. Passengers traveling to inoculation sites must show their bookings, while individuals buying essential goods and services must bring their barangay health pass. The controversial no vaccine, no ride policy was enforced earlier this week in Metro Manila to much confusion and chaos. Mobile journalist Pamela Vasquez, We Are One News.
Now, coming right up, a fisheries group is opposing the government's plan to import more fish, saying the supposed shortage is just artificial.
More of that and other stories when Business World Live returns. Stay with us.
Good morning. You're still watching Business World Live. I'm Jess De Los Santos.
And I'm Danny Laurel. The government is now looking to import more fish on the back of an ongoing supply shortage.
But a fisheries group is opposing this move and insists that the shortage is artificial. Shaila Francisco reports.
Supply of galunggong in some markets is now limited after prices increased early this year. In Mandaluyong and Makati, imported galunggong range from 200 to 260 pesos per kilo, while local varieties reach as high as 300 pesos per kilo. Retailers said problems in deliveries caused prices to spike, while others have chosen not to sell local galunggong for now.
Bumibili lang ng konti para pang paksiw, para makatipid.
The Agriculture Department explains that aside from the closed fishing season, production is also affected by higher prices of fuel and fish feeds. Typhoon Odette also had an effect to the fisheries sector.
They are the number one in the subsector of agriculture, but the heat during the Typhoon Odette. So the capacity of our fishers to catch will be in question.
The Bureau of Fisheries and Aquatic Resources is now estimating a deficit of 119,000 metric tons of supply this first quarter. To fill in this gap, the DA has approved the importation of 60,000 metric tons of small pelagic fish such as mackerel and galunggong for the first quarter. The imported fish must be sold not more than 90 pesos per kilo for wholesale and must be disposed within 20 days upon arrival. But consumers still prefer fresh fish over imported ones.
Sariwa.
Bakit sariwa?
Kasi parang mas maano yung nutrients ng isda dun sa sariwa kaysa sa frozen.
Sariwa. Siyempre kahit anong bagay, mas masarap talaga pag fresh talaga eh.
Meanwhile, Fishers Group Amalakaya calls on the government to lift the imposition of closed fishing season instead of importing supply. The group insists that the shortage is artificial and that there are still enough supply of fish, but the DA begs to differ.
Ang importante natin ngayon, hindi tayo magkulang ng supply. So mas maganda na yung sumobra is magkulang, di ba? It's pandemic pa ngayon.
The DA is also working on increasing local production aside from giving the go signal to import fish supply. Shaila Francisco, We Are One News.
Here are other headlines we're keeping our eyes on. The Finance Department reports that only 5 financial strategic transfer or FIST corporations have been established since last year. Recall that the FIST Act was signed in February 2021. This law allows financial institutions to offload bad loans accumulated during the pandemic by selling non-performing assets to FIST corporations registered with the SEC. The agency said a slow rollout of FIST corporations could be attributed to the continuing strength of local banks despite the pandemic.
Now, a report from the Philippine Institute for Development Studies shows that the fluid nature of online work has led to gaps in taxation and social protection. The think tank notes that these issues have become more urgent with the increased adoption of remote work during the pandemic. Researchers found that the overlapping classification of online workers has affected their tax payments to the BIR. Online workers are often freelancers hired on a per project basis, which means income is not always steady. They can fall under varying categories, could be entrepreneurs, part time workers, freelancers, or independent contractors at different times. The research says that even if online workers want to pay their fair share of taxes, anecdotal evidence reveals confusion with respect to their proper category. Freelance workers are also able to tap social insurance programs, but they often fall into overlapping employment status categories.
Now, Smart Communications achieved the highest mobile internet speed score in the Philippines in the last quarter of 2021. That's according to Ookla's fourth quarter internet performance report. Now, Smart speed score for the period rose to nearly 79 from an almost 60 in the third quarter. Globe Telecom speed also increased to about 33 from a previous 28. However, Dito Telecommunities saw its network speed score fall to 24.47 in the same period. The speed bump for both Smart and Globe contributed to the improvement of the Philippines' mobile internet speed ranking, which is now at 89 out of 138 countries.
PAL said it expects its flights to the US to proceed as scheduled. That's as US authorities already resolved concerns about the impact of 5G service rollout on flight safety, according to the flag carrier. PAL earlier said it was ready to cancel some flights to the US if there were still concerns about the effects of 5G on flight safety, but the US Transport Department already assured the industry that aircraft landing in US airports will not encounter interference from 5G radio waves.
And that's a first look into the business day this Thursday, January 20, 2022. I'm Jess De Los Santos.
And I'm Danny Laurel. Mask on, wash hands, stay safe, Philippines. We are One News.